Welcome back to the channel. I'm Suzanne with Arvabelle, and in this video we are going to go over 7 of the most common mistakes that beginner investors make. If you haven't already watched the last collab video I did with Alyssa and Kevin, be sure that you go and watch that and head over to their channel, Adventures in Us, to see a video that I did about 5 mistakes that I made when I was first starting to invest. If you're not already subscribed to this channel, be sure to hit the subscribe button and hit the like button, and we will get right into number 7, which would be thinking that investing is way over your head. So ladies, I'm talking to you because this is one of my biggest pet peeves. Whenever I bring up anything about the stock market or about investing, one of the most common responses that I get is, oh my gosh, that's way over my head. I'm like, you don't need an MBA or a finance degree or a business degree to learn how to invest. And you don't need a financial advisor. Now, if you are just totally uncomfortable with it and you don't like the idea of investing at all, then yes, go and definitely talk to a financial advisor and have them help you out. But in general, if you take some time to learn about the stock market, you are fully capable of investing by yourself. If you accumulated all of the time that you spend in a week watching TV, watching videos on YouTube, watching Hulu, Netflix, whatever it is, and you instead put that time for 1 week towards learning about the stock market, I guarantee you that you would be much better off than where you were. And it's not rocket science. Mistake number 6 is not paying off debt before you actually start investing. So for most people, simply because their interest rates on the debt that they have is so high and the return that they would be getting in the stock market is lower than that, it makes more sense to actually pay off the debt that you have before you start putting money towards investments. And you have to crunch those numbers yourself. And I'm not a financial advisor, and everyone has a different situation, but generally speaking, just because of the interest rates and your rate of return, it's going to make more sense to address your debt first. So number 5 is not doing your homework. Now, you may have been able to get away with this in school, but when you are investing, you do have to do your research and do your due diligence on the things that you are investing in. Otherwise, you are going to get burned pretty badly. As a beginner or even as an experienced investor, you will have to continuously do research on the companies that you're investing in. Otherwise, it's super easy to get caught in a bad trade if you don't necessarily understand what you're investing in or why you are investing in it. You have to understand the investment, and you need to understand the numbers behind the companies or the ETFs or the mutual funds or whatever it is that you are investing in. You need to understand the numbers behind that. If you just have no idea what numbers you are supposed to be looking at, I will link to one of my other stock market videos up in the cards that kind of goes over some of the different numbers that you should be looking at when you are trying to pick a stock. Mistake number 4 is letting others influence you. And this is likely going to be one that you will constantly have to work at, even if you are an experienced investor, simply because it's so easy to let others' opinions influence our own decisions. Choosing stocks based on what the media is saying, what people on the TV are saying, or what your coworkers or your family or your friends are saying is generally not a very good idea. And especially if everyone on social media is talking about one particular stock or one particular thing, do your due diligence and make sure that you are spending your money and investing your money in something that you personally believe in and that you would choose to invest in anyways. Don't invest in something just because everyone else is. I don't know if any of you remember the whole BitConnect scandal a year or 2 ago, but that's what I'm talking about. Don't invest in something just because everyone else is. You have to do your own research on it. Also, while we're on this subject, be very, very careful about buying stock tips and about buying courses. There are some out there that are very legitimate, but there are also a lot of scams, especially on these courses that are like, learn to day trade, no money down, and make $2 million tomorrow. What? Also be careful with the newsletter and stock tip things that are like, this ex-trader is back after 10 years and blah, blah, blah. And it's like, okay, great. So with either of these things, first make sure that the person selling this is actually credible and actually like knows what they're doing. So see if you can find them online, see if you can find legitimate reviews of their programs, and also check to see if they have any free content. If they do not have free content where you can see their trading style or investing style and see if that lines up with your own trading and investing goals, if that is not available to you, then don't buy it because you don't know what you are getting into. What often happens with these stock tip newsletter things is that the person who is sending them out has already gotten in at a good price, at a price that they want. And by the time that they actually like type up their newsletter, they send it out, it gets to you, you open it, you read it, you go and you log into your brokerage account and you go and try to buy the stock. By that time, the price has probably changed quite significantly. They don't really care because they're already in. But if you get in and then the price starts dropping a little bit, or it just doesn't go as planned, the person sending out the newsletter probably has made a profit, and so they'll be like, look, we just made $3,000 on this thing that I suggested, when in reality, you could have made like a little bit of money or you could have lost money. But the bottom line of all of this is that if you do not understand why you are buying a stock, don't do it. Whether that is because a friend or a coworker suggested it or because some professional that's giving out stock tips suggested it, if you do not understand it, do not invest in it. So mistake number 3 is letting emotions get the best of you. So the stock market, really the intraday prices are driven almost entirely by fear and greed. And whether that's actual people or computerized, doesn't matter. Everyone wants to make as much as they can and they want to lose as little as possible. And when you are trying to make a lot and lose very little, you are dealing with a balance of fear and greed. So if you are investing long term, it's important to not spend too much time analyzing your portfolio in a time frame that doesn't really matter. So what I mean by this is that if you are buying, for example, if you are buying like Amazon and you want to hold on to it for 20 years, you really don't need to be checking your portfolio like every single day or like multiple times a day. You don't need to be doing that because whatever it does in a short time span today is not going to have that much of an impact on what it does over that 20-year time span that you're wanting to hold that stock. You need to not panic and not make any rash decisions based on what's happening in a time frame that doesn't really matter in the big picture. You obviously want to avoid panic selling and you want to avoid getting into a stock because you are afraid that you will miss out. Another side of this is that you don't want to fall in love with the stocks that you are investing in. So sometimes if an investment is just like not working out at all and something's going horribly wrong, or it's just like not the right thing, sometimes you will need to cut your losses. So it's important to be realistic about the things that you are investing in. If you are in love with a company that you have invested in because you think that it's going to be the next big thing, but all of the numbers and reports and improvements or lack thereof are indicating otherwise, then you need to be able to recognize that and to be able to cut your losses. Mistake number 2 is wasting money. So there are so many different ways that you can waste money when you are investing. So first of all, choose an account that is appropriate for your situation and for your individual needs. So for example, a Roth IRA allows your investments to grow tax-free, while something like a 401k, your employer could potentially match. And if you aren't contributing to that, then you are literally passing up free money. Another way that people sort of waste money is by not reinvesting dividends. Later in life, if you are trying to live off of your dividend income or just use dividends as an extra source of income, that's fine. But while you are young, reinvesting dividends just makes your account grow faster. So it doesn't really make too much sense to me why people choose to not reinvest their dividends. Some other ways that people waste money are by withdrawing from retirement accounts too early, and also by buying and selling an unnecessary amount of times within a year and having those taxed as short-term gains instead of long-term gains. And again, I am not a financial advisor, but trading on margin is usually not a good idea, especially if you are a beginner. Just keep it simple and only invest with money that you do have, because what happens if you are borrowing money and trading on margin is that if something goes wrong, you still owe that money. So don't waste money like that. Only trade with what you have. And lastly, a lot of times people are paying too much for commissions, or they're paying too many fees to either have a financial advisor or to have some sort of mutual fund. There are a lot of fees that are associated with different things when you are investing. So nowadays, there are platforms like M1 Finance and Robinhood that allow you to invest without paying commissions. And it makes it very easy to get started with very little money. Now, sometimes paying commissions is definitely worth it, especially if you are like, for example, a day trader that needs the TD Ameritrade Thinkorswim platform. You need that platform, and so you don't really care if there is a $7 commission. And a lot of times, if you are a very active trader, you can call the brokerages and get your commissions reduced by a little bit. It really depends on what you need, but for a beginner, like just starting out, starting with something like M1 Finance is a great idea. So sometimes financial advisors can be really expensive when really you can do a lot of the same things on your own. And sometimes things like mutual funds will have a really high expense ratio. So you always want to check the expense ratio on different mutual funds or index funds or ETFs that you are investing in, and make sure that that ratio is not too high, because those little amounts can really start to add up. And mistake number one is trying to time the market. So I think that one of the most important things is to have some sort of trading plan as you are going into any investment or any trade. So what I mean by this is, like, is it a short-term trade? Is it a long-term trade? How long are you holding this? What is the time horizon for when you want to take your profits on this? Are you trying to hold this for a month, for an hour, for a lifetime? Like, what is your plan? A lot of beginning investors just totally ignore their risk tolerance, and when they see a stock go way up or way down, they totally throw their time horizon out the window and forget what their trading plan was. And again, this just goes back to needing to do your research and needing to have some sort of plan, especially like in the event that we go into a recession or a depression. You don't want to be panic selling, and you also don't want to be FOMOing into other stocks. Patience is a virtue, my friend. You have to be patient with the stock market. Don't chase performance, and don't just automatically assume that a stock is going to go the way that you want it to go. If you're just constantly jumping in and out of positions because you think that you have it figured out, chances are you are not going to end up beating the market. If you would like to hear about the mistakes that I made when I was first starting to invest, be sure to head over to the last video and go to Adventures in Us to watch that video over there. If you enjoyed this video, remember to hit the like button, subscribe to the channel, and I will see you guys in the next video.